And welcome to the latest session of the On the Move webinar. My name is Adrian Day. I'm the co-host. And let me just right away introduce you to our host, Rich Checkan. Rich is the president and COO of Asset Strategies International, which is a diversified precious metals firm, one I recommend highly. I've known Rich for maybe 35 years. He's been president for, we were trying to work it out, but maybe 20 years. But anyway, over to you, Rich, for host of On the Move.
All right. Well, thanks, Adrian. And Adrian needs no introduction, but I'm going to introduce him anyway. Obviously, he's a successful author, a successful fund manager, successful asset manager. He's sought out at every conference we go to. If you forget what he looks like, just tune on the news and he'll pop up on somebody's interview sheet. So Adrian, it's my pleasure to know you and to work with you over the many years. And one of the conferences that Adrian and I both attend, and we both just got back from, was the granddaddy of all conferences, the New Orleans Investment Conference. And that's what brings our guest tonight, Brien Lundin, to us. He's the president of the Jefferson Companies. I've known forever as the producer of the New Orleans Investment Conference. I told everybody down there in New Orleans this, and I'm going to say it to the folks that are listening tonight. As long as there's one person in the audience, we are coming to the New Orleans Investment Conference. Michael was at the first one in 1974. Either he or I or both of us have been at every one since. And we will be there because it was the start of the hard money movement in the United States. I mean, this is basically why we have the industry we've enjoyed for the past 42 years at ASI. And, James U. Blanchard III started, and he's big reason that gold was legalized in 1975, flying planes over the White House saying legalize gold. You can't do that anymore, obviously, but he did it. Gold is legalized. He ran a fantastic conference, and Brien, for so many years afterward, has carried on that tradition, and it is the best of the best. It is the start of our movement. And Brien, thank you for joining us. We love having you.
Rich, a pleasure to be here, and I love it when people give me an especially low bar to clear. I think that we'll have at least one person at our future events, and with you makes two. So we've already got attendance there. But great to be with you both.
Well, thanks for coming along, and we're going to start right there. At the conference. So we all just got back from the 49th annual New Orleans Investment Conference. It was another great conference. There's no question about that. So Brien, we'll start with you. We'll go around the horn here. But what were some of your biggest takeaways from this conference, both from the speakers and from the attendees? As we all know, we learn from attendees just as much as they learn from us.
Yeah, it was, I opened the conference telling people that I thought it was our best lineup, our best roster of experts and analysts that we've ever had at the New Orleans Investment Conference. We've become known, or have been known for many years, as having celebrity speakers, some really big names in politics, and
and Adrian and I too.
So. Yeah, exactly. Of course, headlining, that doesn't need to be said, headlined by both of you and other less luminous lights, as say Margaret Thatcher, Ayn Rand,
Greenspan,
Milton Friedman, and Barry Goldwater, and it just goes on and on. And I found that I don't like to get those kinds of people anymore, really, and it's become difficult for a couple of reasons. One, most of the really big names are dead, and it's hard to get them anymore, and it doesn't seem like we have these kinds of giants of intellectual thought out there anymore, and especially from the political realm. And things have become so polarized in the political world that you end up really just alienating half your audience, no matter who you get. So I've kind of steered clear of that, and instead I've found a lot of people out there who are trying to understand and describe and explain the really weird world we're in these days, financially, in the financial markets and the investment markets, and in macro. And I just find that extraordinary times bring up extraordinary people, and there are some brilliant analysts out there that you see on social media and YouTube and a lot of these other media. And we've done a wonderful job, I think, of getting them to come. And they come to New Orleans now, a number of them, year after year, and it is something they mark off on their calendars every year because of the quality of our audience, the questions they ask, and the quality of speakers as well that they get to hang out with. So one of my big takeaways was how many times I looked like a fanboy and just gushed at some of these speakers. I'm your biggest fan, and I find myself saying that to Lynn Alden and Constantine Kizin. It's like, you know, what more can I say? But it was wonderful for me to hang out with some of these speakers, but also a lot of our attendees got to mingle with them. We can't always promise that, but all of our speakers, it seemed, especially this year, were willing to go out in the halls and talk to people and answer their questions. So I was really gratified about that. The biggest takeaway from the content that I saw was, I think an agreement among our speakers that if anything, if nothing else happens, if nothing else breaks in the financial system, the great tsunami of debt resets that's about to hit the shores of the US and global economy, both not just corporate, but also sovereign debt resets, it's going to be the thing that forces the Fed to pivot. And if history holds true, to do more in terms of policy accommodation, monetary accommodation, than they ever did before. So that's coming. I think it's just a recognition that we don't know when it's going to come, but we know it can't be too much further down the road.
Yeah, no, it's funny because you made the same points I was going to make, Brian. I mean, it's always great when you have a really famous speaker, right?
Yeah.
I mean, having Margaret Thatcher, that was just wonderful. Having Tucker Carlson a couple of years ago, you know, that was great, etc. But one of the things I love about your conference, and that has proved really valuable to me, is you seem to, I mean, you probably spent half the year looking for these bright people who have something intelligent to say, who aren't necessarily well known at the time. And I've met so many people for the first time at your conference. Lynn Alden, for example, the first time I ever heard of her. You said, we've got this great speaker, she does this Twitter or something, never heard of her, but what a great speaker. And others like that. Jimmy, I can't pronounce his name, Iorio, you know, another great speaker and great person. So I think that's really useful. And again, as you say, these speakers are available. They're available around the conference anytime. And you see sometimes they're sitting down with 2 or 3 exhibitors having a coffee, or more likely in the bar. That's probably more likely. But
the exhibit hall and the bar, very popular.
Yeah, they're there and they're available, and that's a really good thing. I think you know, another thing I'd say, which I find very, very useful about your conference, you know how it used to be in the hard money movement, everyone was an echo chamber. We were all standing up to saying the same thing. I think what you've developed in the last few years is speakers who are from the same philosophy, you know, the same broad philosophy, and yet can debate important issues. And a good example of that would be the direction of the dollar. You know, obviously Brent Johnson with his milkshake theory has been talking about dollar strength for some time, but we had other speakers sort of on that side of the debate this time, people like George Gammon, and then we also had people on the other side of the debate, and that to me is really is extremely valuable. So yeah, and the last thing I'll say, and this is not just, you know, because you're here, but the people there, the attendees, they're obviously from a diverse range of backgrounds, but some really smart people, and people who sit in those sessions all day long listening. And then you can have discussions afterwards. Yes, so really, really well done, Brien. Really great conference.
And just my takeaway for what it's worth was, going back to some past speakers, I still get chills down my spine. I was in the front row with my uncle Michael when Alan Greenspan was grilled by Porter Stansberry, Gary Alexander, and I forget who else. There were three people on the panel. I think it was Dr. Doom and Gloom. Yeah, exactly. So I think the three of them, went after Greenspan, and basically they asked some questions that were on all of our minds. If you recall, one of them, I forget who asked it, said, "Listen, you're a disciple of Ayn Rand. You believe in Austrian School of Economics. You believe gold's role in a portfolio. You're not a big fan of debt. Why did you do all the things you did when you were chairman?" And his answer is what sent chills. He said, "You act like I had a choice." And I'm like, "Are you kidding me?" So now every time, the president or the speaker or the chairman of the Federal Reserve says that they're completely independent, there's no influence, I cringe because I know it's not true. And obviously that was a big theme for me. I know Adrian and I are not big fans of the Fed over the past couple of years. Anybody that's watched this show or seen our articles or whatever know that. And of course, he had his big announcement, for the November meeting, the afternoon that everything got going down in New Orleans, right? So we had a lot to talk about, and I do think debt is a big deal. I think it's really they're misinterpreting everything at the Fed. Okay, we'll probably get into this more in a second, but when they look at households that are resilient and household balance sheets that are strong and household savings that are strong because they're seeing an increase in consumption, I think they're completely misreading that. They're seeing an increase in consumption because everybody's buying what they need, and it just costs more after 2 years of rampant inflation, and they can't pay for it. They can't keep up, so they're putting it on their credit card. I think credit card debt now is 1.08 trillion or something like that. The new number just came out from the New York Fed, and I think the Fed and their actions breaking the backs of the middle class, and they're breaking the bank's balance sheets, and it will come to roost. So,
yeah, it's you talk about Greenspan, and when he spoke in 2016, I had a chance to talk to him privately at our luncheon, and I asked him about the debt because that was just starting to concern me, and I was starting to talk about, well, when interest rates reset, when the Fed does try to normalize interest rates, they can't afford to because of where the interest rate is. Well, I mean, the federal debt is, well, the federal debt's about doubled since then. So if I thought it was a problem then, it's really a problem now. But interesting, Greenspan had an interesting comment to me at the time. He said, yeah, the federal debt is terrible and it's a problem. But what really worried him at the time was the derivative exposure of the too big to fail banks. And as you remember, at that point in time, that was a fairly recent phenomenon or move where these major institutions, after the 2008 great financial crisis, had been deemed too big to fail. In other words, they were backed by Uncle Sam. Greenspan's point was that the derivative exposure of these banks, they're all interconnected, and nobody, even the banks themselves, the institutions themselves, did not have a good idea of what their exposure was. But generally speaking, the number numerically began with a Q and not a T. So it's huge. And they don't know what it is, and it's just kind of lurking out there, and all it really takes is one domino to fall. And we're backing all of that. It's not like you can have those institutions fail anymore. And now, of course, those institutions are becoming the great vacuum cleaner of failed regional banks and sucking up those banks, sure, cutting great deals with the Fed and at discounts, but they're absorbing those problems and just getting larger and larger themselves, like amoebas that just keep expanding and expanding. So there's a lot of problems out there. There really are. And the main point that I've been making in my presentations, and as we said, have been echoed or were echoed by a lot of our speakers, is that the debt creates a lot of problems, and it is absolutely insurmountable at these levels. And Powell, as much as he wants to be Volcker, just doesn't have the same toolbox, because the debt's 125 to 135% of GDP. When back when Volcker was raising rates, it was only about 35% of GDP.
Yeah, that's right. And when Volcker came in, as you may not remember, but you've read it in the books, Brien and Rich. When Volcker came in, Fed funds rate was already double digits. People forget that. It was already double digits, but he more or less doubled the Fed funds rate.
He took it to almost 20, right?
12 to 20. There is no way that Jerome Powell and the current Fed, with the current debt environment, there's no way they can go from 5.5 to 11 in sort of a few months.
I don't think they can go to 6 or 7.
Well, that's a
33.5 trillion.
But they can't do what Volcker did, is what I'm saying.
Right.
True.
Yeah. So, Brien, that's a good segue. I was going to ask you about your talk, because your talk, you had the first slide, I think was the first slide. Strange times bring strange bedfellows. Can you expand on what you meant by that?
Yeah, since the 2008 great financial crisis, primarily, but to some extent before that, all asset classes have been driven by one primary driver, and that's been central bank liquidity, Fed liquidity. And what used to be inverse correlations and countercyclical asset classes, the reason why you had a 60-40 stock bond split in most portfolios was because when one asset class went up, the other one tended to go down, and you could diversify and adjust your risk-adjusted return, or optimize your risk-adjusted return. And all that went away post 2008, and every asset class was floated on a sea of liquidity. And these correlations, instead of being inversely whatever, they all trended toward one. Everything was correlated. It all went up together and all went down together, depending upon how the market read the tea leaves in regard to Fed policy. So when Treasury yields would fall, because that would indicate a more of a loosening policy, the dollar index would tend to fall as well, and gold would tend to rise. And then we had a couple of weeks there where everything just went counter to this these long-standing correlations. Treasury yields were rising, gold price was rising, and gold seemed completely indifferent to what the dollar index did. My view on that, my opinion on that, is that this was a sign that the bond vigilantes were returning, which were famous in the 1980s, where they kind of reined in the Fed when it looked like the Fed was losing control, or it looked like the risk of Treasury paper deserved a higher yield, and other than what was being paid at the time, then yields would rise. And it seemed to me that these bond investors were looking ahead to the massive amount of Treasury issuance that was coming up. You have a $2 trillion deficit. You have a backlog in Treasury issuance due to the debt ceiling brinksmanship. And you have what Peter Boockvar was saying at the conference was, I forget the actual number, but it was something stunning, like 25 to 30% of all Fed securities are resetting over the next year or so. So you have this monstrous wave of Treasury paper that has to be issued in the near future. And the bond market was saying we need a higher return on our investments in the face of that issuance. So you had yields rising, in gold. In light of this uncertainty, the Fed kind of losing control over interest rates was rising as well as a safe haven. In the days since, we've seen yields start to fall, and after we saw a disappointing jobs number, et cetera. And I think, especially when you look at the longer end, look at the 10-year yield, yields falling now means that investors are buying the 10-year, with there's greater demand for it. And I think that's because they're starting to bet on a Fed pivot because of the economic numbers coming in. So they looked at the 10-year yield at these levels and are betting on the capital appreciation potential of the Fed pivoting, because that's going to be tremendous. Once the Fed pivots, everything's going to rise, and bonds as well as the rates fall. So I think we've switched from the vigilantes saying we need higher yields, and then some economic data saying, well, maybe that day of the pivot is coming closer than we thought. So they're starting to bet on that event at this point.
Yeah, but Brien, I'm sure you know, at the longer end, I'm not sure your analysis holds. I mean, today's 30-year auction, we've had a series of auctions over the last couple of weeks that were quite soft, but today's 30-year auction was really quite bad, with a huge tail and
terrible,
a very high number of unsold, what do they call it? The bid to cover ratio was very low. So I think, and to me that makes sense. I mean, do you really want to lend money to the US government, or to anyone for that matter? Do you really want to lend money for 30 years at 4.7% in the current environment? I know I don't. And of course, the people that are buying 30 years will tend to be, you're not going to buy 30 years to buy and hold them to maturity. The people who, the institutions that are the big buyers of the 30 years, like insurance companies, pension funds, I mean, they need more than 7.5 to meet their obligations, their liabilities. So they can leverage, of course. But insurance companies and pension funds, in my view, shouldn't really be leveraging. So I think you're going to see I think they're going to demand higher rates at the long end.
Yeah, and it really is an ebb and flow, and you're absolutely correct. So what I was talking about, the flow that we had in at the time of the conference, where rates were yields and rates were rising, and then since then they came back, and today that seems to have reversed with that really terrible auction. And it really was terrible. And the pension funds and the insurance funds that are buying the longer end, they have to, that they are the buyers that really have to buy those. And there's not as much liquidity on that end. So George Gammon made a great point at the conference that there is no reason for anyone to buy, the longer end of Treasury securities, except as a speculation on capital appreciation. And if you can get even higher yields at the ultra short end, then why wouldn't you just do that and not take that risk? If that's
I'm hearing that.
Sorry.
Go ahead, Adrian.
I was just going to say the traditional buyers of long-term US governments, let's say over the last 30, 40 years, as you know, are not in the market anymore. I think it's important we realize that. The Fed used to be the largest buyer of treasuries, which in itself is perverse. I can't quite get my head around how that works. But anyway, they're not buying treasuries at the moment. Then the second largest sector was foreign central banks. And the largest of those were China, Japan, and Russia. They're not buying anymore. And so and the US banks are buying a lot less. They were the next large segment. US banks are buying a lot fewer. They're not buying none, but they're buying a lot fewer 30 years than they were in the past, partly because of all the problems that we had back in March with Silicon Valley and so on. And so when you look at who's buying the 30-year bonds now, yes, it's pension funds and insurance companies. Someone made the point on stage that, on the panel, in fact, someone made the point that, the foreign buyers are still big. Yes, but they're not Japan, China, and Russia that are holding treasuries in their reserves. They're Bermuda and Cayman Island and Luxembourg are the big buyers, and I would be willing to bet that's not the Cayman Monetary Authority buying it for their reserves.
No, you're absolutely correct. That's where all the hedge fund money is funneled through, and some Chinese money as well. But that is a bet on capital appreciation. That's a speculation.
Right.
Every conference I've been going to lately, the people are from the audience and from the podium, they're saying, why on earth would we buy anything other than short-term paper right now? It's free, easy money. It's better than long-term paper. It's a bad investment long term. I mean, we've proven the dollar to be a bad investment long term. It's not a surprise that central banks are shifting their reserves more to gold than to dollars. It's not a surprise that the auction, this is one question Joe had asked, what are your thoughts on today's less than optimal treasury auction? And by the way, keep sending your questions in. We will get to them. Certainly, Rick, we are going to get to your question about gold and why it's not above $2,000. I'm sure we will get there tonight. So keep sending your questions. We will get to them. But it's a bad investment. People are looking elsewhere, and honestly, we knew this was coming. We just didn't know exactly when and how it would, take form.
Yeah, it's not necessary. It's a bad investment, but it's not necessarily a bad trade. And of course, that's only proven at the end of it. It could be a terrible trade if you're betting on that capital appreciation. Especially if you're doing it in a leveraged manner like these hedge funds are, it could be a tremendous winner. But you could actually get your head handed to you if these bond vigilantes come in, and demand high rates. And it really is binary at this point. Either the Fed comes in and because of some crisis and absolutely floods the market with new liquidity as it has in the past, or they're not able to control those rates, and no one is, and they're not willing to step up and buy all of that new treasury paper. The Fed isn't willing to do that, and then nobody buys it, and yields soar. So it's one or the other, but I don't feel like we can just continue along a path where there's a soft landing and everything's hunky-dory. There's just too much risk out there and too many trip hazards in the way.
You had talked about the dangers of higher for longer. Is this what you're talking about?
Yeah, absolutely. And it's inevitable. It's just a matter of simple math at this point.
You're going to say something, Adrian?
No, I was going to ask the same question you just asked.
It just felt like it was natural. So Rick, we're gonna get to your question here as part of this, I'm sure, but we'll move on. So Brien, your thoughts right now, looking at the gold market. What do you think is the best buy out there? Is it bullion, juniors, seniors, something else?
Well, I tell people there are two reasons to buy gold and, by extension, silver. And one is investment and one is insurance. If you don't have any as wealth insurance, then your best move right now is to get some, not just because you should, but because you can right now. As you know, when there's a rush to buy physical metals, it gets eaten up very quickly. The supplies are limited, and then premiums soar, etc. So the best time to buy bullion as insurance is really when you can. As an investment, I think it's an exceptional time to buy metals. I think the gold price is going higher. I think if we've had some examples in the early 2000s where gold went up 20 or 30% in a year. We're talking $3,000 gold if we have that kind of a gain over the next year or so, which I think is very possible. In the investment side of the equation, there are ways to leverage that, and mining stocks are the traditional way to do that outside of risky futures and etc. And they're extraordinary values right now. There are companies, especially in the junior mining sector, that have identified resources, some with economics on them, economic studies, feasibility studies. Roughly what the value of those deposits, of those resources are, and they're selling at a quarter to a fifth of what they should be selling for in a normal market, much less a euphoric market that I think is actually coming. So you can get those companies with much less downside risk as an exploration play, but with the kinds of potential returns that you would expect from an exploration play. So there are a lot of companies out there like that, and it's not that hard to find them. So I think that's a what I called in my presentation a generational opportunity in that sector.
Yeah. Let me ask you two things, if I may, Brien. One regarding the companies, and one regarding the stocks. Yes, what you say is absolutely true about a lot of the juniors and the exploration companies, but aren't a lot of companies, even with good projects, having difficulty raising equity right now for developmental projects? And by difficulty, I don't mean they can't raise it, but they have to do it at a stiff price, whether it's debt. You know, few of the US banks are doing debt for mining anymore. You can get in Canada, you can get in Europe. Equity, the stocks are low, so, you know, the dilution is high. And of course, the streamers and the royalty companies, which are very well financed, always stand ready to give the money, but the price you pay is pretty high. So that's the first thing. And then let me just mention the second thing on the stocks. With regard to the exploration companies in particular, or the smaller companies, which I think is your main focus, do you think we're going to get a lot more downside this year from tax loss selling?
From what selling? I'm sorry.
Tax loss.
Oh, tax loss.
I know you don't have any tax losses, do you? So you don't understand the concept.
Well, I understand that the concept of tax loss because I have occasionally had taxable gains, but that is not much of a problem for anyone this year. So I think it's going to be somewhat muted for the tax loss season, although losses still carry forward and you can still take them. And you remind me that I need to do some of that planning right now. The other part of your question, as far as financing, there's been tremendous difficulty in the market, but the better companies haven't had too much of a problem, or were able to do financings early in the year and are still coasting on those and are well funded and smart management that's, you know, shepherding their resources, their financial resources. So it's been a market of haves and have-nots. If you're not in the haves, you might as well just you know, close the doors and go into hibernation for a while, because until the market turns, you're not going to get any money. But the haves have been able to do some deals and get enough money in the bank. And that is an important consideration that you need to look at. It's not just, are they cheap and do they have a lot of gold or silver in the ground, or even base metals in the ground. It's also how much money do they have? What's their burn rate? When will they have to finance? And they may not have to finance, but do they have enough money to keep making news and exploring? And the best news always comes from the drill bit. You know, companies say, well, we met all our ESG goals, you know, and they put out a news release and that, and nobody cares. You can't even create enough trading volume to sell into in those cases. But you know, people care about drill results. That's primarily it. So if you, one thing to look at for those kinds of companies, are they going dormant for a while, or are they actually turning to drills and making news?
Yeah, well, and I know, go ahead.
I'm sorry.
No, I was going to say, I'm looking at Rick's question here, and he basically said, you know, we haven't touched really on the bullion yet, other than Brien. I agree with you that, you know, there's a component for investing, there's a component for wealth protection. I tend to look at gold as your wealth insurance. I tend to look at silver as your profit option when you look at bullion. And Rick is asking, you know, well, what's it going to take for gold to get $2,000 or above, given everything that's going on? Shouldn't it already be there? And, you know, anybody that would listen to me down in New Orleans, I look at what's going on in the market right now and I say, okay, for the longest time, central banks were the ones supporting the bullion market. We've had 2 years now of record central bank sales going back like 50, 60 years. Last year was the best buying by central banks in 50, 60 years. This year looks like it is going to outpace last year's record year. So the central banks repositioning dollars for gold are propping up the bullion market. Okay. In addition, since October 7th and the Hamas attack, we saw some safe haven buying and we saw some crisis speculation. None of that, in my opinion, is enough to get gold over sustainably $2,000 an ounce. I think you need the investor in this marketplace. And World Gold Council came out with some numbers saying that, bar and coin sales were down 14% year on year. That's the investor. The investor is not in this market. As a dealer, where I'm seeing investors get in this market, other than very, very high net worth folks that have been buying all along because they're not feeling the pinch of this economy, the main thrust, the middle class, they're actually selling right now in bits and pieces to cover needs, right? Where their credit card doesn't cut it because they can't tap into their house anymore. That ATM on a refinance isn't going to work when it goes from 3 to 8% on the refi. So the bottom line is they can't take the money out of their house. They're tapping out their credit cards and they're looking to something else where they have liquidity. They're selling precious metals. So I reached out to some other dealers, Dana and others that were down there and some other friends, and they're all seeing the same thing. Probably since about July, we're seeing little bits of selling by investors, not buying. That's going to continue as long as they're struggling to make ends meet. Once we have investors buying, that's going to change the game, and that'll get us sustainably over 2,000. We're not going to get there without it. Now, that all being said, I think the gold price has been commendable and incredible, given the headwinds. I mean, look at those treasury yields, look at the dollar strength, and gold is still hanging there in the 1900s. I mean, it's amazing what gold has done in this environment.
It's up over $300 since last September. Yeah. Barely more, a little more than a year. That's very strong performance in the face of the headwinds you just mentioned. And I'll just mention a couple of things, if I may, in answer to the question, because that was part of my talk. People look at a war. We had the war in Europe last year, and then of course now we've got 2 wars, and they look at inflation and they think that must mean a higher gold price. In fact, if you look historically, geopolitical events of all types have really tended to have very, very short-lived effects on the price of gold. They can have a short-term spike, but even 9/11, you had a spike, and then a few months later it was back. Look at the Russian invasion of Ukraine, a spike, and then within 2 months it was back to where it was before. So, that's a very, very typical pattern going back certainly over 40 years, 50 years. And so that's a misunderstanding now. The second thing is inflation and gold, do have a, what's the word I'm looking for? They do have a long-term correlation. Thank you. It's late in Puerto Rico. But the point I make to everybody is that it's not a simultaneous correlation. What the gold market does when inflation's moving up, the gold market, like all markets, looks ahead. What's the next step? Well, inflation's rising. The next step is the Fed raises rates, bad for gold. When inflation is coming down, what's the next step? Well, the Fed's not going to hike. And so gold can sometimes move up when inflation's going down on a short-term basis. We've seen that very, very clearly over the past 2 years. If you look at the graph,
pay attention after the very first rate cut.
Yeah.
Now start watching the gold price and see what happens.
That's right. Look over the last 2 years. You'd say there's no correlation between gold and inflation. Yep. But there is. You just have to shift the graph sideways.
Yeah. You do, and I scream at the television when they go on CNBC and they have some of these over-credentialed elite analysts talking about how gold has not been a good inflation hedge, and they show just the chart you're talking about, how there's no correlation. And I'm screaming at the television that we had that last summer, last spring, we had the surge in inflation, and gold didn't do much. Well, because it went up from March of 2020 to September of 2020 and absolutely soared in price, because it was looking ahead and predicting what the repercussions were going to be from that tremendous rescue effort by the Fed. So I tell people that gold is not an inflation hedge. If you want an inflation hedge, you want to invest in, say, energy oil, because that's the only thing that's actually a component of the CPI, so it tends to track it fairly well. But gold is a hedge against people freaking out about the future of their currency. You'll see that gold will just trade along, biding its time and trade sideways while perhaps the CPI is going up. But when people really start to worry, then it makes up for lost time and probably even overshoots equilibrium by a good bit. And those are the times you need to be in gold if you're looking at it as an investment. Of course, as an insurance, you need to be in it all along.
Yeah, 100% agree. And Joe also asked, he's like, there's a lot of talk about inflation. Well, what about deflation? I talked about this in my talk. Everybody a year ago, 2022, they said gold's not doing its job, inflation's higher. My contention is that was consumer price inflation or producer price inflation. But if you look at assets in 2022 were deflating, right? The Fed was pulling the punch from the party, and assets were coming down, and gold was flat. In a deflationary environment, gold falls slower than everything else. And by being flat in 2022, it outperformed the S&P by about 15%, I think it was. Outperformed, or the Dow by 15, the S&P by 20, the NASDAQ by 33, and Bitcoin by 66%. So when you look at assets, whether they're inflating or deflating, I think gold has a role to play there as well. So I don't know if that answers his question.
Sorry. One of my bugbears, I may have mentioned it on this panel before, but, I'm a historian by training. And if you look at history, gold has actually been a better, has had better performance in periods of deflation than it has in periods of inflation. Now, obviously, there's two things there. In the 70s was a period of inflation, gold went up. So everybody thinks, therefore, gold is what you need to buy in inflation. But of course, that was artificial because gold price had been artificially depressed by the government. If you look at history, and then the second thing, of course, is that if you have inflation and gold goes from 1600 to 1900, you say, oh, gold's gone up, well, how wonderful. But if you look at it on a real basis, adjusted for inflation, and you look at it relative to other assets, gold is actually, I hate to say it, not the best inflation hedge. And as Brien just said, oil and other assets will even do better than gold in an inflation on a real basis. If you look at deflation, as you mentioned, Rich, it can go down less, or it can hold its value better than other things that are deflating. Yeah. So if you have a deflationary period and gold goes from 1900 to 1910, everybody says big whoop. But if everything else has declined on relative to other things, gold holds up better in deflations. And I'll just refer you to that wonderful book, Brien knows it, I know, Roy Jastrom's book, The Golden Constant, where he looks at annual prices of gold and annual cost of living in US and in England, all the way back to the 1250s. And you look at in periods of deflation, gold holds up much better than in periods of inflation.
Yeah, and Adrian, that's a good point, because Jastrom does go back centuries, and we really haven't had a deflation since the Great Depression. And in fact, the Great Depression is the seminal example that's used by Milton Friedman was used by Milton Friedman and Austrian economists of looking back, and this is what central bankers will do. And of course, the 20th century, 1900s, was a great rise of the central bankers. And I go back to what one of the first principles that Jim Blanchard taught me when I was a fresh-faced newbie in this business, and that's that central bankers are raised at their mother's breast to abhor deflation, and they will do anything to avoid that because of that example of the deflation. So if there is any sign of deflation, you can bet that the Fed is going to unleash the holy hordes of money printing and just flood with as much currency, newly created currency, as necessary to stem that tide. And that's why they have that 2% mythical, arbitrary 2% goal of 2% inflation, because
keep it from deflating.
Yeah, just to give you a little breathing room from potentially slipping into deflation, which they will not accept for a second. So it's really a question of, would they be able to fight back those forces? And in fact, is that kind of inflation itself creating precisely the kinds of repercussions that you would have in a deflation, or fear of a deflation?
And of course, that's another misunderstanding, because the last deflationary period we had in the US was the 30s, and the 30s was a depression. Everybody thinks deflation equals depression. But of course, we all know here it doesn't. You can have
deflation is healthy.
What?
Deflation is healthy in a free
Well,
market.
the example I love giving is Great Britain, of course, since that's my country. Great Britain from 1815, after we beat the French, through to 1914 on the eve of the First World War, was a century of deflation. Things in England cost less, but the cost of living in 1914 was lower than it was in 1815. And yet nobody would pretend that was not a period of great economic health and prosperity.
Rising productivity, rising trade should bring a deflation in prices.
Sure, but
that's progress.
Well, let me just ask you, if I may, Brien, just to, unless you have something, Rich, I'm sorry.
The only thing I was going to say is a lot of people too mess up on the terminology. So they look at high prices and they say that's inflation. Inflation is the expansion of the money supply. That is what inflation is. And that's what I tell people to look at. If the money supply is expanding, you can pretty much guess where the gold price is going to go in the future. If you have inflation, the expansion of the money supply, you would expect the gold price over time would rise. And when in doubt about gold doing its job, just zoom out. Look at the long-term chart and you know it's doing its job. But go ahead. Yeah.
Well, the question I was going to ask was hinted at by one or two of the questioners that came in. Certainly, it was a big question that was asked repeatedly in New Orleans. So, Brien, what are the factors and what's the scenario you envision that's going to make gold and the gold stocks, gold move significantly above, firmly above 2000, and the gold stocks finally move? What is the scenario that's going to make that happen?
Yeah, and I'll address Michael's question. Michael's a longtime reader and supporter.
Figured you knew him.
Yeah, you could tell by his question.
Yes.
I was going to ask this. But I'll start in reverse, and I'll start about why the gold stocks are in the doldrums, and that's frankly because if you look at the price of gold, you'll see three tops and a refusal to break out. So while gold's performance in the light of rising yields, rising rates, rising real rates has been exemplary just by holding its ground, it has not broken out to the upside. And the investors, the speculators don't get excited about where an asset price is. They get excited about where it's going. So if the gold price has refused to break through those three previous tops, they're not jumping on board. They're not flooding the mining stock market in jumping into that sector. And that's why we haven't had that kind of move across the spectrum from the majors to the juniors. Now, by the same token, that creates the opportunity right now, because unlike the early 2000s, when the gold price was, $252 an ounce at the bottom, and rose steadily for 2 years before the mining stocks really started to move, and it's more than doubled over that time span. We don't need that kind of a move with gold already within a few percentage points from its all-time high. Once we get through those previous peaks decisively, then investors are going to really just rush into the sector, in my opinion, because gold will be establishing a new high and establishing a new uptrend. Instead of 2 years of an uptrend, we need like 2 weeks to get things really going. Whereas why hasn't gold moved yet? I do think you need to look at the fact that it has been performing very well, but it has predicted everything that's happened so far, and now it's waiting for that next move. You know, you mentioned, Rich, that when the Fed cuts rates, just watch gold take off. I disagree with that a bit, because gold will take off before the Fed cuts rates.
Good point. Yeah.
And considerably before. And I think that's why it's in kind of this holding pattern right now, waiting for that seminal event that we all know is going to happen.
It senses it's coming. I think we all know the Fed is done.
We just don't know what it's
Powell's
going
not
to
saying
be.
it, but he's done. He's out of ammunition.
Yeah, and you know, people have asked me before, what do you think Powell should do? And I say, I think he should run. You know, I really do.
I was gonna say resign, but okay, same thing.
Pack up his briefcase, go to a mountain hideaway in Montana or something, and just get out while the getting's good, because
He's fighting for legacy. Nobody wants to be the guy in charge of the Fed when the dollar died, you know. So he's just trying to hold on for dear life right now.
There is no way out. The Fed is essentially trapped by the debt that has been built up by all previous regimes.
He's got an impossible task. It reminds me a bit when people say, you know, what should the Fed do? It reminds me of, you know, that old Irish joke about the car in the middle of Limerick or whatever wants to go to County Mayo or whatever, and the farmer says, "Oh, if I were going there, I wouldn't start from here." And that's exactly what it is with the Fed. I mean, when they started raising rates a year ago, it was already too late.
Can I share
already too late? But the fault was keeping excessively loose money and ultra low rates for so long.
Yeah, and not just that, but pumping all that loose money into an economy where you had structural supply issues.
Well, Adrian is right on the mark. The Fed cannot do this alone. They need the help of Congress, and it seems like nobody in Congress has the appetite to stop spending. There's no leaders anymore. You said it early on, Brian. I agree with you. Nobody can make those hard decisions, and as long as they keep spending more than we take in, Powell can never fix this. Okay. I want to share two quick things. So I did an interview with Kitco, and somebody who was at your conference who is in politics, really nice gentleman. His wife came by, and they were very nice. They said, listen, you know, I saw your interview and really thought you did a great job. And thanks for sharing your insights. And I recognized him because he was in my breakout session as well. And I said, I said, I just got to ask you, you mentioned you're in politics. And, you know, I have a slide on in my presentation where I go pretty hard on the fact that politicians on both sides of the aisles have been basically destroying our currency for decades. And I said, I hope I didn't offend you. And he's like, oh, no, you're absolutely correct. So that's one. The other story is a good friend, Alex Green. He's been on this show before. Yeah. I think we all know him very well, investment director at Oxford Club. And, you know, he went to dinner with a friend and some senator. And I forget which one. It'd probably help if I could tell the story properly. But they're at dinner, and the senator asked them, what is it that you want me to do for you? And Alex said, I want you to stop spending money. And the senator said, I'm sorry, what? And Alex said, I want you to stop spending money. And the senator said, you know, nobody has ever asked me to do that before. That's our problem. Stop spending money. Let's live within our means, like every household in America has to. And I think we can still fix this. I don't think this problem is too far gone. But Powell cannot do it alone. You're right on target, Adrian.
No. Well, I would disagree with you, Rich. I think the problem is too far gone. I'm an optimist by heart, but given the debt load that we have now, there's only a few ways you could get out of it. You could grow your way out of it, and
I think that's the answer, by the way.
I think it's too far gone for that to happen. The good news is that all of the other factors we talk about are like straight line depreciations, whereas growth compounds. So growth is the best route out, but you have to have a setup for that, and that means low taxes, less government regulation, and that may be as intractable a problem in government as spending.
We need leaders.
You can raise your taxes to attack the problem. You can't really do that. That's not an outlet. Nobody's going to get reelected doing that. You can cut spending. Obviously, nobody's going to do that because, again, you can't get reelected doing that. You can't cut entitlements, which are now, you know, the vast majority, and that in defense spending are the vast majority of government spending right now, only to be eclipsed soon by interest on the federal debt. So
how bad does it have to get before we can do all those things?
Well,
Because we need to do all those things.
My view is that we're going to have some kind of a reset or jubilee or whatever at some point. If in fact the central banks in the world, they're all in this together, but the Fed leads the pack. So if in fact the Fed is going to react to every crisis of its own making, which it will never admit, but every crisis that comes up with ever greater amounts of financial accommodation, the monetary accommodation, ever easier money, then at some point the currencies themselves are going to lose credibility and people are going to start behaving. Not you and I and the attendees at our audience who are already well aware of this, but the Uber drivers, you know, the people on the street are going to start saying this money is not going to be worth much when the next crisis comes, because they're going to do all this again. People are going to start treating the currency like trash, which it essentially is becoming. So to regain that credibility, there's only one thing they can do. They have to attach it to something. Yeah. They have to attach it to either, you know, maybe Bitcoin, but I would argue that the thing that they'll attach it to is the one thing that has worked forever, and that is gold.
Is that the gold card that Michael's suggesting here in the questions? It's time to play the gold card.
Yeah,
assuming
well, I
we
think
still
it may
have it,
be.
right?
We'd have to ask Michael, but I think that it is. I think there will be a reset at some point. And the fact is, a gold standard, despite what, you know, Milton Friedman and some other people have argued makes it unworkable, it's actually very workable. It just means that when you do devalue, you have to do it publicly, and you have to do it with accountability. You're the one that's doing the devaluation. That's why politicians don't like it.
Yeah.
If in fact you need more currency, you need a looser monetary policy, you just raise the price of gold. And you don't have to have full coverage of the currency by gold either. Yeah.
Thoughts, Adrian?
I know. Look, that's a huge topic, and
yeah, we went down the rabbit hole, didn't we?
We have another couple of hours here.
I will just say I disagree, but we have to do all three. We absolutely do not need to raise taxes to solve 100%. Anything. First of all, you couldn't raise enough taxes to solve the budget deficit, number one. But secondly, you need to cut taxes in order to, you know, let the entrepreneurial spirit loose and see growth in the economy. Agreed. If you increase taxes, you're just going to cause a more long-term sluggish economy. So
raising taxes decreases revenue. We've seen it time and time again.
Sure. But I thought you had said you wanted to do all three.
No, we need to do a lot of different things. You know, we need to stop spending more than we take in, et cetera.
You know, I think we should get to that question of Don. About the experience, what happens to gold and miners in a recession? I can talk to it, but can you talk to that, Brien?
Yeah, you know, again, if there is a recession, and it depends on how the recession starts. If we're talking about a liquidity event like 2008, a liquidity vacuum, then everything goes down for some very short period of time. It could just be a day or two. We saw that as we were kind of working our way through 2008, where the gold price would actually go up or down $100 in a day, and in a day or two or more. And so, you know, nothing's going to protect you in that kind of environment. You just have to kind of hunker down and survive it until that passes over. But in every economic slowdown, the recipe has been the same from the Fed. Prior to 2008, it was to cut interest rates. After 2008, it cut interest rates. It started something called quantitative easing, and it built a moat around Wall Street and the financial system to protect the financial system. After COVID, everything it did over, say, 4 to 5 years in 2008, it did over literally 4 to 5 days. It brought rates right back down to zero. And instead of just protecting Wall Street in the financial system, it injected monetary adrenaline directly into the veins of the economy by just giving people money. Yep. And so it did everything from 2008 to a multiple in 2020. And in the next crisis, if there is a recession, to get the same effect on this economy that has become tolerant of that monetary adrenaline, tolerant of that drug, it's going to have an ever greater dosage to have to use an ever greater dosage to get the same effect. So I'm not afraid of a recession and the effect on gold or gold miners. I think that gold and gold miners are your hedge against that event because we know what the central banks are going to do.
Yeah, absolutely. And let me just say, I had this slide on this in my talk at New Orleans. I'm a historian, as I mentioned. If you look at the last 9 recessions in the US going back to the 1960s, in all but one of those recessions, simply looking at the period that the national, whatever it is, economics thing defines as a recession, gold was up in all but one of those. And the only one it was down was the early 2000s when, remember, the European central banks were selling their gold heavily. But be that as it may.
Is that about the time England was getting a fantastic deal on their gold? Is that about that time?
Oh,
the brown bottom.
Yep. So in all but one, gold was up, and in the one it was down less than 0.5% in US dollar terms. That's number one. What about gold miners? The gold miners were up in all but 3, so in a good majority of those recessions. The gold stocks were up, and they were frequently up by 100 or 150%. And in all but one of those cases, believe it or not, the gold stocks outperformed the S&P. So the clear evidence is you absolutely want to have gold in a recession. You definitely want to have gold stocks, and the gold stocks will most likely do better than the S&P. Now, you can play with statistics any way you want, but what I did was a logical thing.
Yeah.
I took 1 month after a recession started, because as you say, when you first have that drop, everything drops. So I looked 1 month after the recession started and gold was up in every single recession. Then I looked at 2 months after the recession started and the gold stocks were up in every single recession. So that's a clear lesson. You want to be out of the way of everything when you get a first drop. And then gold, as we know, comes back very quickly, and the gold stocks follow soon after. And it's precisely because of what you said, Brien. When we go into a recession, the markets look ahead. And everybody knows in a recession, the Fed is going to start cutting rates. And that's the trigger for gold, I think.
Yeah, I agree. The markets are predictive mechanisms, and I think that gold and bonds are the most accurate of those predictive mechanisms. Sometimes the stock market gets stuck in narratives that kind of obscure that story, but the smart money is represented, in my view, by bonds and gold. And the volatility we've seen in the bond market is telling right now that it seems to indicate that a shift is coming up, some kind of a turning point.
100%.
And I see there's another question here from Todd. I'll pass that around for everybody, but just everybody that's listening, be sure to stay around to the end. We're going to let you know how you can get the conference tapes so you can hear all the things that we saw and heard ourselves there in New Orleans. You'll be able to get them as well. Brian's put together a nice deal for you to do that. I highly encourage you to do that. But before we get there, Todd says, do you have any best practices, percentages for having precious metals out of your home country, say out of US, Canada, UK to Singapore, Cayman Islands, etc.? You guys want to tackle that, or you want me to jump in?
I think that's yours.
That's what I thought. So
Yeah.
The first thing I tell folks is when you're going to buy gold for wealth insurance, and I agree with Brien, that's the first and always purchase of precious metals is gold for wealth insurance. I encourage people to take delivery of it first. Okay, that's the number one. And the simple reason is gold's purpose as wealth insurance is it's a store of purchasing power with high liquidity for a potential financial crisis you hope to never have. So if you have that crisis, you need to be able to put your hands on it immediately and meet your financial crisis. So you need to keep it close at hand, but you don't want to have any more close at hand than what you need to bridge any short-term foreseeable gap to where you can access funds elsewhere. Okay. And or you don't want to have any more than you feel comfortable safeguarding and storing yourself. Okay. You definitely want to keep a low profile. You don't want to go bragging to your neighbors, come look at my gold coin collection. You just keep it with the loved ones. You tuck it away and you pay no attention to it unless you need it, because it's this cheapest way to store precious metals until it's lost or stolen, then it's 100% loss. Okay. So that's where you start. But anything over and above those levels, I like putting it in the hands of professionals. I'm a big fan of that. The more you have, the more I suggest you diversify. I have no problem having other assets with depositories, say in the US, if that's where you live. I have no problem with branching out to Perth Mint. We work pretty closely with them for a very long time, many decades. Our friends at SWP in Cayman Islands, you can have some in Europe, you can have some in Asia. So if you have 10 ounces of gold as your allocation, then you're not going to put it all over the world. You're going to hold that close at hand at home. If you have considerable amounts of money put into precious metals, I suggest you get protection, asset protection, by spreading it around. And there are some incredible professionals out there that can watch your metal and can be trusted to do so properly. And if you have any questions who they are, we can help you. So I hope that answers your question. But in terms of percentages, that's different for everybody. I'll just tell you, and it's in my talk at Brian's. So if you buy those conference tapes, you'll get it. But basically, I like 10% of net worth in gold for wealth insurance. And then I like another 10 to 15% of investable assets, not net worth, in gold and silver for profit. And that I weight towards silver. We haven't talked much about silver here tonight, but I really think that there's some energy building up there and it is ready to go. I'm kind of sick and tired of everybody saying gold at all-time highs, gold at all-time highs. I think gold anywhere around $2,000 is dirt cheap. Okay. If you look in the big picture, if you zoom out and see where this is going because of the monetary expansion, you got a chance to buy gold dirt cheap, and it's been an elongated opportunity. I would take advantage of it sooner than later. I don't think you have to rush and buy it yesterday, but it is there for the taking. And silver, even better by orders of magnitude. So I hope that answered your question, Todd. Let me see. Scott's got a question, unless somebody want to add to that.
No, I thought that was a great answer.
Yeah.
Okay. All right. So Scott says, very informative discussion. Thank you. Sadly, how can the forward sales ever be stopped? Not constantly holding back rallies, thoughts, besides creating an incredible squeeze. Anybody want to jump on that one?
It's a tough nut to crack. It really is. Right now, as far as owners per ounce of gold on the COMEX, it's actually at the lower end of its range, which is kind of telling in itself. But as long as we have the central banks buying like they are, and I think they will continue to do so, I don't think they're rushing to buy right now or trying to fill up coffers and then going to stop. I think they're on planned purchase programs now to build up reserves. So it's going to go on for a while. I think that continues to put pressure on the futures exchanges. I think that's why you're seeing the owners per ounce has dropped. In other words, the registered holdings have risen as a percentage of the open interest. The other part of that is, you mentioned forward sales. What I think he's referring to are actually futures.
Yes, I'm sure.
Forward sales is a big issue. It has not been an issue for a long time, and Adrian will know this very well. When Barrick was was not a gold miner for a long time, it was a financial institution designed to preserve the jobs of the management teams. Hopefully, we are going to get into a situation at some point where the producers are going to be wanting to sell forward again, or tempted to, because that means the price is rising very strongly. I don't think we're going to get to that point. And I see he came on and said, yes, he was talking about the futures and not forward.
Yeah, we're all on the same page.
Hopefully I addressed that a bit.
Right. Yeah, you answered the question on futures. Just to look at gold hedging, you know, there's very, very little gold hedging at this point.
Right.
Among the companies compared with what there was 20 years ago.
Yeah.
When, as you say, Barrick was I don't know, poster child's the right word, but when they were the poster child and they were simply speculating on the price. You know, there's nothing wrong in a developmental company raising some of the funds they need for building a mine by selling forward some of their production.
Yeah.
I don't think there's anything wrong in that, because when when you're a development company and you need to raise $200, $300, $400, $500 million to build a mine, however you do it, you're going to take dilution. You bring a partner into the mine, you're giving away part of a mine. You sell equity, that's dilution. You borrow money with all sorts of terms and conditions, or you get a streamer who takes part of your production. However you do it, there's a cost.
Time value of money.
Sometimes selling forward part of your production, preferably just for a year or two, not forever, but selling forward can be a legitimate, and it can be the cheapest way for you to raise money to build your mine. I have no problem with that. What I don't like, and I think what most gold investors don't like, is when gold mining companies are speculating on the price. So, you know, if you've got a gold producer and they're hedging their currency, they're hedging their diesel, they're hedging their arsenic, no problem at all. Hedging your cost inputs, but, you know, let the price of your product free to go where it is. I think that's the key. And the questioner, Scott, mentioned the word squeeze. I know this is not what he was talking about, but it made me think of something. But I think it's important for us to realize, and we've all sort of alluded to it. Rich alluded to it with the premiums on coins and so on. You know, the interest in gold and gold mining companies right now is just so low.
Horrible.
That when we do see a move, I think we're going to see a pretty explosive move. And I think this is a reason that gold investors not only do, but in my view should hold on to these things for year after year when they go down, 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 because the up moves can be so explosive. And you only have to think of, you know, after the 1976 recession, or you look at 2002, or you look at after the 2008 recession, or for that, you know, after each of those moves, the gold stocks moved up at least fourfold. That's for seniors.
Yeah.
At least fourfold in a matter of a couple of years, you know, 2, 3, 4 years. And they were up 3, 4, 5, well, a minimum of fourfold, as I say, but 4, 5, 6-fold for the seniors. And of course, the juniors were up even more. And so, you know, that's why I think it makes sense. I don't think it's a mistake to hold on to companies where the stock price just keeps deteriorating, because the rallies can be so strong.
Good point.
Yeah, it can make up for those, you know, your typical portfolio management argues against it. You know, if a stock goes down 50%, it has to double to break even. But those are the kinds of returns that become commonplace in a bull run like that. And you're not just talking about the stocks, you're talking about the metal. There have been, you know, you can cut it a number of ways and define it a number of ways, but there have essentially been 3 major bull markets in gold in history, really, because it was money beforehand. So since 1971, you had from 71 to 75, gold went up about 7 or 8 times in price, and from 76 to 1980, it went up about 8 times in price. In the 2000s, it went up about 8 times in price from the lows. So the next time gold has a major bull market, it's probably going to go up 7 or 8 times in value. And I marked that low of the last cycle at $1,040 on a spot basis. So that's the kind of potential we're talking about. And if you have mining stocks leveraging big moves in gold, if you're going up 7 or 8 times, you can imagine the kind of mining stock market we're talking about.
Yeah. Do you want to talk, Brien? I know some people would like you to, but do you want to talk about some specific names or specific areas people should be looking at?
I certainly can. You know, with my memory being what it is, it's hard for me to remember a lot of the stocks in my portfolio. But there were some great companies in New Orleans. Is that what you're talking about? Talking about some of the specific names?
Yeah.
Yeah, I would say, you know, I'm talking or recommending companies that have big resources that are selling for a fraction of what they should be selling for. I think in the gold sector, I think Banyan Gold is one. It's got about 6 million ounces. It's selling for about $10 an ounce in the ground. And in a normal market where there's M&A activity, resources like that would typically sell for $150 an ounce, maybe as low as 100. But you know, some would argue the average would be closer to $150 an ounce. So that's the kind of potential you have there. A company that's selling for $10 an ounce in the ground. In silver, Vizsla Silver is a company I like a lot. I own Vizsla. I don't own Banyan currently, but Vizsla is one that's building a tremendous resource. I believe it's over 100 million ounces now. A very high grade silver, close to surface, identified structures, going to be very easy to mine. Has a mill on site, but more importantly has permits, because the mill really won't be appropriate for the size of the mining it's going to be doing. It's tremendously undervalued in light of its resource right now. In base metals, fireweed metals used to be called fireweed zinc, because it now has a tungsten project. It's called fireweed metals. It has what could be globally strategic deposits in both zinc and tungsten, and very well managed. And again, you look at the Lundin family, which unfortunately I'm not closely enough related to be included in the estate, but they put a lot of money into that company, and they're pretty smart investors. So that would be 3 names I would throw out there right now that pop into mind. And I'm bringing up our portfolio as I speak. But those are 3 companies that I I'm not. There's no guarantees in investing, but I would find it hard to believe that over the long term you would be hurt by investing in these companies at these levels, and very high probability of over the next 2 or 3 years getting greatly rewarded for owning them.
And when you're looking at juniors, what are the things you're looking for first and second?
Well, people will tell. I think it's a combination of things. People will tell you management is the most important. Management often typically gets the best projects. In some cases, a deposit doesn't know that it's owned by idiots and crooks. But in that case, your risks are greatly enhanced, because they can screw up a deposit, and it's eventually the good management that gets a hold of. And there's a lot of stories like that in the industry today. It's not so much discovery, but rediscovery, where a previous operator was not able to really take hold of that story and get it developed and get it to capture the public's imagination. Vizsla Copper is one of those stories where Craig Perry is a very kind of a serially successful financier in the industry, and has taken over the Woodjam deposit that was not able to get traction in previous market, but comes with a 1.7 billion pound low grade copper resource, along with nearly 1 million ounces of gold in lower grade, but is a wonderful optionality play on copper, which is a longer term story to begin with. So, you do look back to your question, management is key. The structure of the company is very important, but the deposit, I think, and the potential is king. And when you're looking at a company, you want to make sure that it has the size of the prize is worth it. You want to find a company that has a very large resource or is on track of making a very large discovery, on gold, 1 million ounces or more, because nothing else is really going to move the needle for the market.
Do you follow all those three in your newsletter?
Yeah, I do. And I own Vizsla Silver and I own Fireweed, I should have mentioned personally. I also briefly mentioned Vizsla Copper, and I own that one as well, but I don't own Banyan at the moment. I would if I had enough deployable capital, but I tell you, it's a target-rich environment right now, and it is, as I said, a generational opportunity. And I'm as invested as I can be right now.
That was meant to be a setup question, Brian.
I know.
You didn't run with it. One of the mistakes I find people make, I have people come to me and say, will you review my portfolio of gold stocks? I look at it and I'll say something like, oh, this one, Consolidated Ajax. I don't know about one. Can you tell me about it? Well, is it gold? Is it silver? Don't know. Is it in production? Not sure. And what happens, you find that somebody heard about the company from Doug Casey or Adrian Day or Rich Checkan or Brien Lundin, and then they never, they didn't follow up. And so I always say to people, if you're going to take Brian's advice, and there's nothing wrong with that at all, you've got to get his newsletter so that you follow what he's saying about it. You can't just build a collection of these things based on recommendations.
Yeah, and what I tell people is it's a very inefficient market, and that's to your advantage if you're willing to put in the work and the time, the effort, and the money you need to go to the conferences. This is all obviously self-serving, but on our website we have an investor's guide to gold and silver, and we talk about all the best newsletters out there that I view, and I talk about all of the conferences out there that you should attend, not just mine and not just my newsletter, but if you can dedicate the money to subscribe to 3 or 4 of the best newsletters, and if you can go to 2 or 3 or 4 of the best conferences out there, you can get a leg up on other investors and find these gems that are just, lying at your feet in this market that are overlooked temporarily, or the new opportunities that are just developing, because getting early on some of these deals, especially in a bull market environment, is one of the real keys to maximizing your returns.
Yeah.
So Brian, go ahead, Adrian. No, please.
I was just going to say, over the last 10 years, being late has actually been to your advantage.
It is, and the newsletter, actually the alert I just put out yesterday, I noted a company that I talked to at my conference, that I had talked to at PDAC in March. And at the time, a lot of my fellow newsletter writers jumped on this company and were recommending it because it was well run, had a great joint venture, had great properties in Nevada, but I didn't sense that there was a near-term catalyst. It seemed a bit expensive at the time for what it was, and I was a bit unsure about where the market was going, so I didn't recommend it. So in that case, the procrastination, or not recommending it, was to our advantage, because it was trading for around 40 cents back then, and it's trading for about 23 cents now. So, and it's a much better company because it has proven, or is in the process of proving, the theory that it had back then with drill holes.
Gotcha. I was going to just say, I think it's probably about time to wrap up. We've either answered everyone's questions or we've put them all to sleep. I'm not sure which it is. I can't really tell from where I sit. But I'd like to kind of go around. We'll start with Brian, Adrian, and basically final parting thoughts, although I think you just kind of shared some. And Brian, be sure to tell people how they can sign up for your newsletter. In the follow-up email that we'll send out over the next few days to this webinar, we'll have the full webinar link so everybody can go and revisit. That's going to be available, but also there'll be a link in there where you can sign up for the conference tapes for this year's just finished New Orleans Investment Conference. Fantastic information. And with that, Brien, make sure they know how to get the Gold newsletter, but your parting thoughts.
Yeah, thank you for that, because I usually do forget to promote myself. But yeah, I do believe this is a generational opportunity. Gold is within a few percentage points of an all-time high. Once we break out of that all-time high, you're going to see money flood into this market, and the values are as the mining stocks are as cheap as they've ever been. From the fiscal standpoint, you can get metals right now. The premiums are not out of line, and it may be your last chance, because once that seminal event happens, whatever that catalyst is that we know is going to happen, then it's going to wipe out all of supplies of physical bullion on a retail level in the market very quickly. And if you want to get it, you're going to have to pay extremely high premiums. So this is one of those times you need to buy it, because you can buy it, and we all know what's coming up is coming. Gold newsletter, you can go to goldnewsletter.com. Very simply, it is the oldest precious metals advisory in the world, longest running, and I think one of the better values out there right now. And you have the link for the conference recordings. This is I think both of you will attest, and anybody who went to the event was absolutely blown away by the quality of the content and the analyses and the predictions and the specific picks that were provided at this event. It's tens and tens of hours of extraordinary insights, and it's one of the most affordable prices of one of the best deals you'll ever find in the investment industry.
100% agree. Adrian, parting thoughts?
Yeah, the only thing you don't get by getting the tapes, of course, is the food. So
yeah.
it's
you do get the transcripts, by the way. You also get a transcript. So
yeah, but you don't get the food.
No, you don't get that. That's why I tell people to come in person.
Absolutely. No, but
join us next year. We will all be back there. Absolutely join next year.
Definitely. And the tapes are a great deal. I agree with what Brien said. I mean, whether we're 3 months away or 6 months away, we are very, very close to a fundamental turn, in my view. And as we've just discussed, when gold turns, when the stocks turn, particularly now, given the extraordinarily low valuations and the extraordinarily weak sentiment, so most generalist investors have zero exposure to gold. Given both of those factors, it's going to be quite an explosive move for a few years, in my view. Last thing, you can reach me on www.adriandayassetmanagement.com. That's just adriandayassetmanagement.com. No dots, no apostrophes, no hyphens, nothing. And I say this every time. If anybody has any questions that we didn't get to, or you think of any questions, please reply to Rich's email. I'll do my best to answer them if I can.
Yeah, thank you, and you always do. I'll kind of hit on the theme. I said it earlier. I think gold at 2,000 is cheap. It's get this thought of all-time highs out of your mind. It's so ready to go, and silver even more so. I've been to 2 conferences. I'm down here in Miami for another one. That's why I don't have my gold backdrop like I usually have. I've taken a bunch of Uber rides and a few taxi rides over the past few weeks, and not one of the drivers has told me how much money they've made in gold and silver or gold and silver stocks. It is a great time to be buying well with all these investments. And, again, the tapes will be available. The conference or the webinar follow-up will come out here shortly. Usually we have it out the very next day. But my marketing coordinator is getting some much deserved time off. She set everything up before she left, and she's going to try to make this happen from abroad. But it may take a few more days than normal, but it's coming. Don't worry about that. You will all get it if you're registered. And I encourage you to do the conference tapes. I encourage you to sign up for New Orleans Investment Conference next year. It is a fantastic venue. It's a can't miss on our schedule, and we'd love to see you there. Like we saw some of the folks here tonight asking questions were there, and it was good to see you guys face to face. And with that, gentlemen, thank you very much for your time. I know, Brien, you look for that week of sigh of relief after the conference, and we did let you get it this year, but thank you for joining us. And Adrian, as always, your insights are incredible, and thank you all for joining us and listening, and hopefully we brought you some value here tonight. And happy Thanksgiving to all, and happy Veterans Day to all those veterans out there. We appreciate you dearly.
Thank you.
Thank you. Thank you, everyone. Thank you. Have we stopped?